Namaskar and welcome to our special program on pre-budget expectations. Today we'll be focusing on the economy and fiscal support, whether the budget will need to provide some sort of stimulus for the economy to sustain growth. Now, to discuss this, we have with us two eminent guests. Let me introduce you to them. Dr. Rajat Kathuria is Professor of Economics and Dean of the School of Humanities at Shiv Nadar University. And Dr. Suranjali Tandon is an economist, assistant professor, the National Institute of Public Finance and Policy. Thank you very much for being with us. Dr. Kathuria, let me start with you. So reports suggest that the fiscal deficit, which was 6.8% in the previous budget, would actually revise to about 7.1%. And this was from 9.5 in 2020. So the question that comes to mind is how long will it take to consolidate this over time?
Thanks, Mark. Actually, I think that the fiscal deficit that was planned as 6.8%. There's been some surprises during the year, and some of the surprises are that actually the tax revenues have been more buoyant and expenditures have not kept pace. So with the result that the expectation is that instead of 6.8, there might be a slight reduction of the fiscal budget to actually 6.6% if the reports that one is seeing in the media and coming out of some rating agencies, including some official sources, suggest that actually the fiscal deficit target might actually be met. Not only met, it might be reduced. Now, this is a double-edged sword because at the time of the pandemic and during the pandemic, you actually want fiscal stimulus. You don't worry so much about the fiscal deficit. You worry a lot more about spending and whether you can blow up consumption, you can increase investment. So in that sense, it's not such good news that the fiscal deficit actually come in at lower than the amount that was projected by the government. And I think in an overall sense, of course, if we didn't have the pandemic, we should have been close to 3% of the fiscal deficit. But because of the pandemic, the fiscal deficit targets have not been met. The original fiscal deficit targets of fiscal consolidation to 3% and 0% revenue deficit, I think that is still there on the horizons. But I think they'll have to be deferred much more than was initially expected.
Dr. Tandon, so fiscal support is necessary to support growth, especially since we're talking about a pandemic. But this should be done, obviously, to stimulate self-sustaining growth. That's that's the way. I would look at it as an outsider. But as an economist, how do economists look at it?
Yeah, Mark. As Dr. Kathuria has also pointed out, this is a time when you have to step up spending. And, any lesson from the past is that periods of slow growth and recession have to be matched by step up in government expenditure. I would assume the same for the Indian economy. We've been seeing a slowdown in capital investments. There's been a little talk of job creation, which has been slower. And, I think there's not been a consensus on the shape of the growth. But there's definitely enough clamor about different segments of the economy being hit hard. So I think the budgetary allocation has to be stepped up for all the segments that we believe have been adversely or severely affected by this particular slowdown, and has to be sort of pulled out. If you're saying self-sustaining, then it has to be pulled out by capital investments which have long-term impact, or multiplier impacts on income. So yeah, I would say fiscal expansion at the moment would be extremely important.
Okay, Dr. Kathuria, so social sector schemes where government spends all the time, and now we've talked about production-linked incentives. This is to boost manufacturing. Are they self-sustaining? What kind of economic returns do they give us, and how are they quantified?
So social sector schemes by definition, I guess, will not be self-sustaining, but they are necessary. For example, if you look at a social sector scheme of the kind of NREGA, typically which are unemployment benefits given to families for 100 days, and those sort of requirements, those demands have actually gone up. And, as expected during the pandemic, those demands have gone up. So these sort of schemes on education, on health, I mean, typically what you describe as social sector, some of them will not have, returns to the government in a pecuniary sense. But obviously, education investment, health investment has returns, and those returns are in the form of non-pecuniary. You could quantify them, of course, you could be quantified, but they will come over a longer period of time. But these schemes are absolutely necessary today, social sector schemes, because of, as I said, the pandemic and the increasing burden, I guess, that is being placed on agriculture. At a time when India is growing and being the fastest emerging market in the world, fastest growing emerging market in the world, you would expect that there would be people moving out of agriculture into manufacturing and services. You're actually, because of the pandemic, you're seeing a reverse trend where the burden on agriculture, which means the burden on productivity in agriculture, is actually reducing, which means there is more demand for social sector schemes. There is more demand for NREGA, for people who lost jobs and lost employment opportunities. On the other hand, schemes like the PLI can have immediate benefits. Immediate in the sense of job creation, in the sense of higher exports, in the sense for higher gross value added. So those schemes are good. In fact, every country has an industrial policy, Mark. And we've been shy of sort of trying to have an industrial policy. I think PLI is an industrial policy, and it doesn't target exports. It targets sort of manufacturing, and some of it will lead to exports. And I'm glad we are thinking about schemes like PLI now, which are not foul of the WTO, unlike the previous schemes, market export intervention schemes, which were like targeting exports. But schemes like the PLI are not foul of the WTO anyway. The WTO is another beast altogether today. So PLI will have returns, and they can be sort of in terms of jobs, in terms of exports, in terms of gross value added, and they'll also provide a boost to growth. Let me add one more thing. With the engines of growth within the economy sort of petering out, especially because of pandemic, consumption is down, investment is not picking up. What are the other engines of growth? If you look at the classical macroeconomic identity, exports and government support. And this is exactly what we're doing. Government support in terms of Capex and export to boost our rates of growth.
Dr. Tandon, then what about non-tax revenue potential for the government? Has it come down because of, COVID? And does the government need to tap into reserves? After all, we've had 3 successive years of disruptions. So, I mean, that question also arises.
Yeah, Mark. So for this particular year, there had been ambitious targets on disinvestment, which is a non-tax receipt. There were a couple of ideas in mind that the government had, but as we look at the revenues today, they are not up to mark in terms of the targets that were set. We were supposed to collect about 6 lakh crores over the next 4 years, and we are short on target for this year. I think it's an ideal time to disinvest because of these stock markets behaving the way they are. Stocks performing much better. So I think that's one area to explore to sort of bump up the receipts, although I do see some promise in the numbers of the GST and corporate tax collection pickup. But having said that, non-tax receipts, you'd see more focus on disinvestment. And of course, borrowing will remain the mainstay because, let's not forget states are going to shoulder the responsibility of pickup and states are dependent on borrowing. The government has taken a sort of positive view on how states can expand their fiscal space. So over the next year, I imagine that you will see the expansion in non-tax receipts, which are in the form of higher borrowing and in the form of disinvestment proceeds coming from the national monetization pipeline.
And Dr. Kathuria, with regard to direct taxes, because the budget largely deals with direct taxation since the indirect taxation is now part of the GST Council. So the question is, what kind of tax relief could people be expecting? Because after all, their livelihoods have been impacted by the disruptions caused by COVID. And what kind of relief can the government give them? it's also a political decision in a sense.
Of course, the budget is in a sense, the entire budget is a political document. But these are special circumstances today, the pandemic, and there's no gainsaying that. Also, the government has begun the process of direct tax reform a few years ago. Corporate tax rates have been brought down to sort of fairly competitive levels, and I think I don't think more relief can be provided on the direct corporate tax fund front. And even in terms of direct personal taxes, I think there are the reasons to believe that, given the inequality levels in India, and some of the reports that have been coming out, that during the pandemic the inequality levels have actually gone up. I don't think we can make a case out for reduction in tax rates. Maybe some exemptions can be increased. But I think rates, I don't think there's a case to be made out for that. But on the other hand, a case can certainly be made out for increasing tax revenues without touching the rates, and that is getting more people under the tax net. India has been an under-taxed economy, not in terms of tax rates, but in terms of the identifiable group or the target group that pays taxes. A lot of people who ought to be paying taxes, and we know this for a long time, don't actually pay taxes. And one of the things that tax administration has been wanting to do is get more and more people under the tax net, and also have a more sort of friendly tax department or a more friendly tax administration. And I think these sort of things have happened in the past. Yes. In government budget, faceless assessment, faceless appeals, and a large tax or a large taxpayer code, etc. These are all sort of good things to adopt within the country. So without really touching the tax rates, making the administration more efficient, increasing the tax base and therefore the tax to GDP ratio, and probably in a special year, try and give some higher exemptions to certain individuals, increase the exemptions, or get rid of these cesses. I think even the cesses there are cesses every year that are put on the tax. So I think consider not levying any more cesses. If you don't want to reduce the existing cesses, at least let's not have the surprise of more cesses in this budget.
So more simplification is what you're talking
Absolutely.
about. Dr. Tandon, we are in the middle of the third wave, and by all accounts, it's a wave that is large on numbers but low on on how severe it is, the severity of the pandemic. But they're also the feeling that we've been there and done that. So can we say that the impact on the economy is going to be less severe than in the past?
Yeah, so Mark, if you look at high frequency indicators, whether it's in terms of the level of production, or if you look at even GST collections as a high frequency indicator, you see that the trough has been going up, in the sense that the decline that you see responding to an economic shock has actually gone down, which means that the severity of impact of these subsequent waves on GDP and on overall level of activity has gone down. And I expect that in the third wave, we'd see even smaller impact as compared to the second wave. Unfortunately, the second and the third are bunched in the same financial year. So we'd see the combined impact when we see the end of the year numbers. But I believe that the third wave's impact on the economy is going to be slower, and we're going to bounce back faster.
Okay. So then, Dr. Katuria, should we be looking ahead? Because we still have in the rear view giving us, that COVID is not, we are not past this, even though we might be more confident in dealing with it. The question is that there could be more mutants coming and things like that. So how do we weigh the odds, and do we factor in, for these kind of exigencies, or should we throw caution to the winds and support entrepreneurship, support factors that can push growth at this time?
Yeah, we shouldn't certainly throw caution to the winds. I think we should plan ahead. And that planning ahead will be no different, I think, Mark, from what we were planning in the pre-pandemic days. I think the shortcomings, what the pandemic has done is the shortcomings of the Indian economy have come to a fore. And I think the main shortcoming or the main weakness of India's economy, huge economy now, one of the largest in the world in PPP, is jobs. And I think it was no different pre-pandemic. What was the thing that was affecting the economy the most? It was jobs. And you sort of, in your question, the underlying character of your question also signifies that you're talking about entrepreneurship. And I look at entrepreneurship as a method of creating jobs for the Indian economy. Right? So the focus has to be on entrepreneurship, but it's going to fulfill a very, very marginal part of our requirements of job creation. And I think, therefore, the focus on manufacturing, the focus on investment, people coming out of agriculture will need to find productive jobs elsewhere. And it's going to be difficult, but the pandemic has brought these, I think, weaknesses to the fore, and we need to do more of the same. Focus on investment, focus on, ease of doing business, focus on connectivity like Gati Shakti, get goods, logistics moving faster, both interstate and GST is doing that, and to the port so they can be exported faster. So nothing different, but get the sort of our own internal house in order. And the focus has to be on jobs. And if the focus is on jobs, then the focus has to be on MSMEs, small and medium enterprises, which are really where jobs are created in any economy. And India is no different. And I think manufacture is going to be the main creator of jobs in the future, not services, productive jobs. Services gives you a lot of informal sector, unproductive sort of jobs. But the focus, I think India's focus should continue to be on the manufacturing sector, albeit in a very difficult global environment.
Dr. Tandon, reports suggest that Capex, and for the sake of our viewers, let me explain what it is. It creates assets and it reduces liabilities. So this is being targeted at 6.5 trillion rupees, or about 6,50,000 crore rupees, and it was 5.54 lakh crore rupees in the last budget. So the question is this a significant increase given the constraints that we have on the revenue side?
There are two ways to look at it. One is to look at it from the numbers that were earlier projected, and definitely it's a step up from there. The other is what's required, and what I see is that there are different sectors in the economy which are looking forward to higher capital investment. Even if you look at a sector like defense, there is a need for modernization. If you look at infrastructure, there's the demand to step that up. So I believe that capital investments will be much higher, and if nothing else, this signals a trajectory which is in line with the expectations of economists that pulling the economy out of recessionary phase and to build sort of jobs, better jobs for people, will require capital investment. So I would say that the numbers moving up is a good sign, but is it enough is a question worth asking.
Dr. Kathuria, is there scope then for the government to reduce revenue expenditure? The Modi government has been trying to remove, inefficiencies in the administration. The government has been highlighting that, we have to move out of this silos mindset. What do you think?
Well, that definitely has to be on the table. Maybe not during the pandemic year, because you need to boost consumption and get money out in the system. But I think, reducing revenue expenditure has to be a goal over a period of time. We keep saying that budget documents actually should have a lot of continuity in them, and they do. Frankly, when governments come to power, they have a certain goal in mind, and there is some continuity in budgets, and I dare say there'll be some continuity in this budget as well. But I think I remember in 1996 or thereabouts, mid 90s, we had a proposal from the then finance minister, I think it was Mr. Jaswant Singh, who said we'll reduce revenue deficits to zero and we'll increase our capital. The question you just asked, Ranjali, we'll increase capital deficits productively, which basically means that we'll put our money in investments, which will give you rates of return, the question that you had asked earlier, and reduce revenue deficits to zero, which means that all our revenue expenditure will be financed by our inflows, tax inflows, and therefore it'll be zero. Now, of course, given that this is a pandemic year and you need to continue increasing revenue, and as Suranjali said, that states are going to be spending a lot more during this time, and their borrowings will probably be a lot higher. I think that this should remain a target. The revenue deficit equal to zero over a period of time should remain a target, but I think it will be too optimistic to predict when it can happen. But yes, I mean, that should be an aim for the government, yes.
Dr. Tandon, you did mention about defense expenditure. Now, some of the key aspects of expenditure, both revenue and capital, are in relation to defense and international relations. And, India is now an emerging power, a global power, and these are sectors that must be seen to be invested in as well. So how do you think, I mean, what kind of efficient expenditure can be made in these areas?
Mark, defense is an important part of our budget, and we've been seeing some requests to modernize the equipment, which means that there is more need for capital expenditure. But we have to bear in mind that it's a necessity that requires revenue expenditures to be funded as well. You cannot wean the sector off it. So what you see is that there will be growth, continued growth in the expenditure space, in defense expenditure. But I think a good way forward is to imagine a PLI scheme for the defense manufacturing. And in the last couple of years, there has been some easing of FDI requirements or caps in this sector. There's been invitation to private sector to come and participate. I mean, not saying that we shouldn't be concerned with the national security angle, but definitely better private participation with targeted schemes like the PLI could actually help ease off the pressure on the capital side or the capital expenditure side of the defense budget.
Dr. Kathuria, what should the fiscal deficit be in this budget, and will there be a problem with inflation going forward is also the question.
I think it looks as if the government might be able to rein in the fiscal deficit even for this current year, rein in the sense that lower it from even the 6.6 range that it is expecting to target for the last fiscal. It might come down to 6.5%. And it's not a small amount, it's a big amount. And if you include the states, of course, it could touch double digits levels. But I think my advice, and I think that has come through in the responses that I've been giving, is that the focus should not be on the fiscal deficit right now. The focus should be on getting out of the crisis that we are in, getting out of the pandemic. That of course is a separate matter outside the budget. Hopefully we will be, but the focus has to be on fiscal stimulus, on investments, and to prop up the economy. And government has various instruments, tax, non-tax instruments, crowding in of private investment by making its own investment, thinking about coastal economic zones that it had once in the past. But I think that idea has not been discussed subsequently. But, thinking about these things so that we can create jobs, we can create fiscal stimulus, we can create consumption and investment. Yes.
A final question to you, Dr. Tandon. Some of the smaller countries, their currencies are at risk from crypto assets, at least that seems to be the discussion, because of inflation, because the crypto assets are more stable than a currency that is unstable. So, and that can cause instability in the systems in these countries. So we are a larger economy, we don't seem to have that kind of problem, but we are moving towards a digital currency. What would you think? I mean, would announcements be made in the budget, and should we be moving quicker in that direction?
So it's a tricky situation with the digital currencies. We move forward, but we've not really taken a stance at the moment. What you're seeing in terms of inflationary pressures for smaller economies is because inherently their currencies are not stable. And so if you introduce another medium of exchange, you're going to that kind of volatility for a period of time. For countries like India, that's not an immediate concern. And, the RBI has said that it would think of a central bank digital currency as an option. But of course, it really depends on how the regulations are written. What is the kind of movement of money that is allowed on CBDC opposed to conventional currencies. and what happens to the velocity of circulation of money. But I think these are all long-term thoughts on what will do monetary policy and the monetary system if you move to digital currency. At the moment, I think it's all still very much in the offing.
So we leave it there. Thank you very much, Dr. Rajat Kathuria and Dr. Suranjali Tandon. And it appears that fiscal support is necessary, not only because it's a pandemic, but India needs to sustain high growth levels. And I think our guests are also in favor of supporting entrepreneurship that we are already showing, through our startups, that we are a country that has plenty of ideas, and we are looking forward to a number of new interesting things that will come out from the budget, but fiscal stimulus will continue to be part of this budget. Thanks very much for being with us. Namaskar.
Thank you.